Bitcoin bull is back, baby. And I'm not going to call it absolutely. Bitcoin bull is back, baby. And I'm not going to call it absolutely, but if we surpass 21.9 on this kind of third rally, we've made 3 successive higher lows off the 17.5 wick. And I'm starting to feel like spring is coming. So I was early, euphemism for wrong, on winter. But maybe I'll be early and rightish on spring. So when you have on the positive side, when you have higher lows and higher highs, and because markets chop, right? Markets don't go straight up, they don't go straight down. They chop because human beings react greed and fear. And there are 2 types of markets. Winter and summer are distribution markets, when people are selling, distributing, and accumulation markets, when people are buying. And signs of accumulation are when you get a low and then it starts to go up and then people get afraid and they start selling and it pushes back down. But then there's more buying pressure, so it doesn't go as low. So you make a higher low, and then you go up again, and then you start to come down, and then you make another higher low. That pattern of higher lows is the formation of, you've heard it called a bottom, a rounding bottom. And if again, people say, drawing lines on charts doesn't do anything. No, it doesn't predict things. It doesn't cause things, but it lets us see patterns of behavior. And that's why, a month ago or 5 weeks ago, I tweeted out that thing about, look, the longer we stay on this flat, what's called a descending wedge pattern, where you're bouncing up and you're bouncing lower each time, the longer we stayed in that pattern around 30,000, the more risk there was of that cathartic puke. And I said 15 and we made to 17.5. So again, it's not about prediction precisely. It's about directionality and pattern recognition. And it's just because human beings, the traditional market, not done. It's got a long way to go. And the problem is too much leverage, right? There's still a mass amount of leverage. We corrected the amount of leverage that was higher than 18, which is orders of magnitude higher than 2008. There's so much margin debt in stocks that needs to correct. And as it corrects, the problem for stocks is stocks are still 54% overvalued relative to fair value. They've only been this expensive 7% of the time. In all of history, 140 years of history, only 7% of the time have U.S. equities been more expensive than right now. That includes the drop this year. On the flip side, Bitcoin has only been cheaper than its long-term history. The red line, stocks go up. Over the long term, stocks go up. Why? Inflation, right? Our currency gets less good, so the value of assets goes up. Earnings, right? Companies actually earn money. And growth, right? There is economic growth. So those 3 things make that red line go up about 6% compounded in real terms a year. And the problem is stock prices reflect greed and fear. And the greed is when we're above the red line, and the fear is when we're below the red line. And you can be above or below for a long time, but we've been above for a very long time. And to get back to fair value requires 54% drop from here. This is 2001 redo. And I've talked about this and talked about it ad nauseum. People forget 2000 was not the bad year. Right? 2000 was the warm-up. 2000 is when people went, oh, wait a minute, this is stupid. And we started to go down, but then we had this relief rally where the Fed said, we're going to save everyone and we're going to print more money. Because the Fed had printed one half of a trillion, not 10 trillion, but 1/2 of a trillion leading up to Y2K because they were afraid the world was going to end. And when the world didn't end, people looked at stock prices and went, oh, geez, these are pretty high. And so March 24th, that was the top. But then the Fed came back in that first quarter of 2001 and said, no, we're going to provide liquidity and we're going to save us. And so we only ended up down 6% for 2000. But 2001, when Stan was getting whipsawed, was you had this rally. And we went all the way back almost to equal from, I think at one point down 14, 15%. So it was a vicious rally from kind of the middle of November through December into January, February. And then the stuff happened. And literally, then they started selling it again later at zero cost, which is just so insane. But they wrote it off and they said, oh, we have to restate all of our earnings from the last 5 years because we kind of exaggerated. And it led to the discovery of fraud. And there was a lot of fraud. There was Enron and WorldCom and all this stuff. And look, 2001 was a crappy year. It was down 14. But 2002 was the really crappy year, right? That was down 22. And so you still had plenty of time. And if you look at a bubble chart, at a traditional bubble chart, and you can maybe attach it to the show notes, it goes and has that false bear trap where it kind of falls. And then it kind of goes parabolic to the top, and then it rolls over. And then you have the last cathartic kind of turn up. And it's called a return to normal. As everybody's like, no, it really is a new paradigm, that term new paradigm, which anytime someone says that, just run away. And then you have the drop, and the drop accelerates through capitulation and fear, and then you get to loathing on the other side. And if you remember first quarter 2003, right before we invaded Iraq for the second time, that was when people were like, I'm done with stocks. I'm done. I never want to see a stock again. Institutions were like, we're not going to invest. And that was clearly a good time. The Bitcoin, I was making the case that Bitcoin is a good asset. And these people, we are so early, Michael. These people, like one woman came up to me and said, I disagree with everything you said. This is a Ponzi. I'm like, well, look, if you don't know the difference between a Ponzi and a pyramid scheme, then we can't even have a conversation. Because by definition, it is not a Ponzi. Not a Ponzi. You can call it a pyramid if you want, just like any other currency in the world, which is built on faith and belief and foundation. But you can't call it a Ponzi. But this audience wanted nothing to do with Bitcoin. Now remember, this is Pacific Northwest, this is Amazon and Microsoft, and we're rich because we're smart, and they want to have nothing to do with anything. But what I said is, they said, well, there's not a hedge against inflation because inflation was 9% and Bitcoin didn't go up. I'm like, oh, wait a second. In the last 2 years, the Fed, this big spike on the chart, the Fed printed 50% of all the dollars in the history of the Republic, 256 years. Oh, interestingly, if you print 50% of the dollars, that means you basically devalued by 100%-ish, right? Because you've doubled the money supply. Bitcoin's up precisely 100% in that 2-year period. It just happens faster because it's not a lagging indicator like inflation. Inflation is a lagging indicator. It's what happened a year ago or 6 months ago. It's not real time. It didn't happen immediately when they printed the money.